Welcome to Hong Kong U Space and Asian Pacific Loans Market Association webinar. Today's topic is current market developments of leveraged acquisition and syndicated finance. I'm Ringo Chen from Hong Kong U Space. Let me introduce our speaker today, Mr. Joe Zhang, Executive Committee members and Board of Directors, Asian Pacific Loan Market Associations. Mr. Brian Yeung, Board of Director, Asian Pacific Loan Market Association, Executive Director, Head of Loan Originations and Syndicated and Leveraged Finance at JP Morgan. Welcome to our webinars today. Today, we will focus on the following agenda. As you can see that, we would like to give you an overview of our partner, Asian Pacific Loan Market Association, and then we would like to give you an overview of leveraged finance. And then our speakers will share with you the update, development, current trend in the loan markets. And then we would like to give you the more ideas about development in this leveraged finance sector. So now, may I pass the time to Joe to give us about the overview of Asian Pacific Loan Market Association. Thank you, Joe.
Thank you, Ringo. So Asia Pacific Loan Market Association, we are the voice of the loan market in Asia. We were established in 1998 to deepen the liquidity, transparency, efficiency of the APAC loan markets. We support the market development through advocacy, best practice guidelines, best-in-class documentation, and training. As of today, we have more than 400 institution members covering banks, non-bank FIs, law firms, data providers, and other vendors. So we are in 35 plus countries. We have 400 plus institution members. In our events, we have more than 10,000 attendees attending. We have 120 plus events per year. We have committees and working group looking at loan issues, and we have 17,000 individual members as well. So it's a very widespread organization in finance.
So maybe I'll start and chat with Joe about what leverage finance is. I'm sure the participants are actually very happy to hear that as well. So I think number one question, 101, why the borrower is borrowing money? I think that's the most important question to ask if you are a bank or a lender, because without a use of proceeds, it's very difficult to establish why are we lending that money to them. Because lending money is also a risky business because you're using the bank money to do business, but then if you lose all the capital. If you gain the interest only, unlike equity. So loan is a very specific product. We look at more downside than upside, so to speak, to make sure the risk is appropriately mitigated. So understanding the rationale is important. Generally, we see rationale or use of proceeds including, number one, that they have to refinance something, as in they borrowed money before, so that they'll have to refinance it as in when the borrowing or the facility is up for maturity. Number two, they acquire something. So for example, company A wants to buy company B. Company A don't have all the money they have to acquire company B. Company A would like to raise an acquisition financing for that purpose. There are also other potential use of proceeds. For example, company A just want to do some capex so that they can increase the capacity and increase the utilization rate so that they can make more in terms of revenue and EBITDA, one of the reasons why. And number four, which is a little bit more exotic, is a dividend recapitalization, meaning a financial sponsor, let's call it a KKR or CVC or some of the more established financial sponsor, they want to pay a dividend to the shareholders, meaning the fund themselves. They can also do a borrowing on that. I think that's basically where we generally see the use of proceeds are. It's a very important question to ask. Sure.
So I think in terms of leverage finance, it's important to understand what a CFO or treasurer is thinking. Why did you do leverage finance, right? And if I'm looking at an investment, I can finance by equity or debt. equity, obviously, the cost of equity is much more expensive, right? While debt, it's obviously we look at downside protection, but the cost of capital is much lower. So if they use debt or more debt, basically they can minimize the equity check, and also that helps with the return on investment, right? And whether look at money multiple or IRR, it's going to help with the leverage and return as well. So that's why borrowers look at leverage finance.
Thank you, Joe Brown. May I ask you just one question? Being a layman in this field, what is the biggest risk in terms of leveraged finance for both bank and the companies that raise the money?
So if I start first, the biggest risk is obviously default, as in they cannot pay the debt in time, or they're not able, period. They're just not able to do that as and when it is due. And to break that down, obviously there are multiple reasons why it happens. For example, they borrow too much at the beginning. For example, the market they operate in, having an industry issue from a trend perspective. Let's just say many years ago, and probably before some of you were even born, Yellow Page is a very good example. It was leveraged 10 times of their EBITDA because everybody thinks that Yellow Page is not going to die. Everybody's going to use it. You refresh it every year. But once iPhone came out, or once internet came out, it became immediately obsolete. So that's one of the risks. And some other risk, including regulatory changes, which we can't actually anticipate. So the more important thing from a bank perspective or from a lender perspective is to mitigate and analyze the risk that we could analyze. As in, are they borrowing too much? What's the industry trend? Some of the risk, there's just no way to be mitigated.
So that's why it's very important for leverage finance to look at the recourse. So if there's downside in the business, what can we do about it, right? What sort of guarantees, collateral, security we can have, right? In a very bad adverse scenario, we can look at enforcement, right? Previous to that, we can look at restructuring, right? So it's very important to look at recourse. What options are there for lenders, right? The other very important thing to think about is what's the leverage we are looking at, right? So leverage finance, we always look at sizing the quantum of financing. There are many different matrices we can use. The most common one is a net debt EBITDA test, which is leverage ratio. We also can do it, size it against more on the balance sheet basis, so debt to equity, debt to asset. We will be also looking at the cash flow debt serviceability. So you have EBITDA interest, DSCR tests. And then we also look at, so day one, if they do the acquisition, what's the acquisition value or multiple they're coming in, and what's the leverage they're taking, right? What's the equity check we have? So I want to give the audience an analogy, right? It's like playing Angry Bird. You have a slingshot, right? You pull too hard, too much leverage, you're not going to hit the target, right? You put too little, you're not going to go anywhere. So you pull right amount, you hit the target and you play the next game. So I think it's very important for us to think about what's the right level of leverage.
It's the like a combination of art and science. Correct me if I'm wrong.
Obviously, there's no hard and fast rule for each company.
Thank you. And another issue which is I'm thinking is how about the current macroeconomic situation and political consideration? Will it affect the leveraged finance fundraising, etc.?
So I think leverage finance today is a very rewarding business for banks because normally once you layer the leverage finance, the debt, the credit rating or explicit credit rating, it's going to be sub-investment grade, right? So it's more high risk, but your returns also higher, right? So I think there's a more element of uncertainty today in leverage finance because of geopolitical tension, of deglobalization, of changes in the trade supply, etc. Right? So it's this uncertainty is making leverage finance harder to do. So if we look at leverage finance uncertainty, I think firstly, if we look at there's sell side and buy side. There's a seller and buyer, obviously, right? Seller still wants a very good valuation to exit. For the buyer, I think what we're seeing is that the buy tension is also increasing, right? Because if you look at corporates, they want to acquire asset, they want to grow their portfolio, have synergies with the portfolio, right? For PEs, the sponsor side, these PE sponsors are getting bigger and bigger as well. If you look at the top 10 asset manager globally, they are really consolidating all the asset, right? So PEs are also very aggressive in the bids as well. So you can imagine if we are providing a financing to a buy side, we may not win because we may be backing the wrong horse. And then if they sign an SPA, maybe regulatory issues, the trade doesn't go through, right? So there's a bigger element of uncertainty today for leverage finance.
Yeah.
Thank you, Joe.
And that links actually pretty well to what legal counsels do in terms of our transactions, because we're Asia Pacific business, so we don't limit ourselves to one country. So of course there are a lot of mainland PRC deals, there are a lot of Japan, Korea, Singapore, Indonesia. There's no way, well, I don't know about Joe, there's no way for me as one person to know every regulation. So basically, we depend and we rely on the legal counsel or the local legal counsel to give us the right advice, such that we do not hit regulatory traps, so to speak.
Thank you, Brian, Joe. So I think probably we would like to see your views of current trend in the loan market. Maybe Joe first.
Okay. So I think in terms of the trend for the loan market, if we just look at 2024, the loan market was around 540 billion. That decreased around 7.8% year over year. In terms of deal count, it also decreased from 1,615 to 1,400. And if we look at countries, China remains one of the key countries. It's around 111 billion, but it decreased by 45%, mainly because of the real estate issues and economic slowdown. Hong Kong was 113 billion. It was increased by 12%. There were a lot of blue chip borrowers across different sectors. There were jumbo loans done. For example, ByteDance and Syngenta raised mega-sized billion context loans. Singapore was around 80 billion. It increased 50%. There was an increase in commodity trading firms looking at financing. And then Australia and New Zealand, it was around 110 billion, increased by 47%. There were a few jumbo loans, including like Macquarie Group, raising a 7.4 billion deal. AirTrunk, a data center operator, raising a 5.5 billion Aussie dollar deal. And there were refinancing, M&As, and large transactions done throughout.
Thank you, Joe. Thank you.
So maybe I can give the audience a perspective of the themes we're seeing in today's market. First of all, there has been lack of deals for banks to deploy. I think that's various reasons why. So what's happening is that banks are becoming more aggressive in terms of the ticket size. They're trying to deploy more in transaction if they can, and that has what has changed is that pricing margin structure is basically becoming more borrower friendly because banks want to deploy desperately. In terms of M&A financing, there has been some pickup. I think that's blessed by how interest rate has decreased gradually. When we think about interest rate, we use it as a cost of capital in terms of valuation, right? At a high interest rate, normally valuation can go down. When interest rate goes down, valuation usually go up. And then when interest rate go down, you can also think about debt as well. It's easier to get financing, right? So if we look for next few months, hopefully with interest rate coming down, that should also help with M&A, to support M&A. And then the other thing is in terms of the PE sponsor side, there's a lot of liquidity. There's a lot of dry powder, right?
Right.
So in terms of PE, a lot of focus is to look at buyouts, control buyouts. So that's going to be a theme for the next few months and towards the end of the year as well. Lenders are still quite focused on resilient credits after what we've gone through in terms of COVID-19. So we're looking at cash flow driven business, resilient business, defensive business. And then I think the other trend that we're seeing is private credit. So in terms of leverage finance, obviously borrowers can go to the banks for financing, but they can also go to the institutional investors for financing as well. And my personal perspective is that these are complementary. They're not really substitute, at least in Asia. Because the things that we look at for banks and private credit is very different.
Yeah. Thank you.
Yeah,
Thank you.
maybe one or two more from me as well, more from a trend perspective, but more from a geography perspective. We are seeing pickup or more potential transactions in India, given where the business is, given where their economy is, and given where their IPO market is. There are more and more potential for Indian companies to be acquiring either another Indian company or an overseas company. And that's where we play, as in we help them to finance them to acquire business overseas, structuring complex overseas acquisition transactions. That's India. We also see uptick in Southeast Asia, in particular some of the Singapore-based or more globally or Asia Pacific business, which is Singapore-based companies. They are also becoming a little bit more active, given they are being quiet for the last few years, with a little bit of pickup. In Hong Kong and also China or Greater China region perspective, I think activities remain relatively stable and flat, given where we are in terms of the economic cycle as well as different industry trends. Japan is a very red hot country, given where the interest rate is, which basically echo what Joe has just mentioned about valuation. Their interest rate remain very, very low because of their base rate. Liquidity remain very, very flushed. And that's why we are seeing a lot of activities in Japan in terms of acquisition as well as loans.
So in Japan specifically, I think the regulators is trying to promote few things. So one of the things they've been looking at is looking at listed companies. If their PB ratio is below certain times, they should really think about spinning off, selling non-core asset. So that's number one. Number two is there's increasing shareholder activism. They don't want family in cross holdings, right? You can imagine Japan is always about family owning A, B, C, D, E, F, G, H, I, J, K, right? So they want them to be more lean and more efficient. So that's also encouraging, M&A. And then you add the financing costs and also the PE activity. Japan is really increasing, activity over the last few months.
I see. Yeah. So Japan appears to be a spotlight at the moment.
And India, I think. Japan and India.
Right. Yeah. In terms of M&A activities, what do you think, given that the DeepSeek effect, do you think that, for example, technology sector will be more M&A activities in the coming year?
Definitely. So I'm also working on a transaction of similar sorts. Of course, very, very confidential. But then, yes, exactly. So basically, technologies company basically now have to, if they haven't before, they have to look into the space of, you call it the OpenAI or DeepSeek or general AI to make sure that they keep up the curve. And that drives two things. Number one, of course, acquisition. They can acquire shares of those companies. That's one way of doing it. But even if not, that will also drive financing needs for technology companies to develop their own AI stuff. So we're seeing a lot of pickup in that sector and hopefully driving the volume of the loan business up.
We should ask DeepSeek.
Okay.
But I think for AI specifically, that has been an increase on data center financing.
Yes.
Right. Last week, I think there was just 7 billion of data center financing alone. And I think it's very interesting because banks are providing a lot of capital in that, but it's only a certain leverage or gearing, right? And data operator centers have a big pipeline of data center to build, right? So they're also looking for mezzanine financing, perhaps to get more leverage to grow their business. And then AI data center, you can also think about the need for energy. Because data center consume a lot of energy, right? So in India as well, and various parts of the world, there's a growth in renewable, whether it's wind or solar, right? Because of the huge energy consumption. And then for data center, as you know, they use a lot of chips as well, like GPU, NVIDIA GPU chips. So we are also seeing, not really for banks, but more for private credit institutional investors, providing creative financing just against the GPU chips, right?
I see, right. I got one question from our audience, which is maybe for both of you. Can you share your views about the risk and opportunities of private credit market in China?
You want to go first?
In China.
I go first.
Okay.
Yeah. So I always talk about opportunity first as a banker. So opportunities in China for private credit specifically, I think if you are a risk taker, you got a lot of business to do, because in China currently, I mean, for all benefits, there are situations and issues for some borrowers from various sectors, such as, for example, real estate, such as, for example, education, that they might find it difficult for traditional bank market supports, given where they are in the current situation. If a private credit is able to analyze that risk correctly and be able to go back to what Joe's mentioned, have a good recourse to what happens next, it's a good opportunity. Now, the risk come to that as well is that while you are investing in or basically lending to that company, which is currently quote unquote may not be in their best shape, what if it goes continually down? Then you're losing your capital. That's number one. And number two, as in when the financing or basically the facility you're giving them right now goes into refinancing, what is the refinancing out, which is also what we care about. As in, when we lend to them, we don't expect them always pay down to zero. We always expect some form of refinancing that will happen as in when it matures. But if it is for that company, they might not get defaulted, they continue to pay you interest, but if you can't find a refinancing source, then chances are you may just keep extending your credit to them.
So I think for private credit specifically, when we look at Chinese transaction, a lot of the investors, they would try to see if there's any offshore revenue, offshore asset that they can ring fence as part of the collateral. Right. Because they know in a bad scenario, you can enforce more quickly, right? If I'm enforcing onshore asset, it's going to take time, right? And there's a lot of regulatory things that we need to tackle as well, which is beyond this call, I think.
Sure.
Yeah, but I think first of most, think about what offshore revenue there are, offshore asset, try to ring fence that, and then maybe you size the loan against it, right? A lot of times people would also look at capital market, like, look, I provide you financing, and then we do a trade sale, IPO, equity placement to take out the private credit loan. So that's a key question. Is there a real takeout from capital market for them? And it's very, very difficult for takeout sometimes for Chinese companies because they need to go through certain regulatory approval, right? And it takes time.
Right. Thank you, Joe. Thank you, Brian. Let's see the other refinancing and M&A loans volumes. Perhaps maybe Brian can give us some insights about this market trend.
Sure. Yeah. I think first of all, when you look at this chart, there are a few things to look at. So we started, or we dated back to 2018 because we want to show you what quote unquote pre-COVID, where the market is. Now, 2019 was basically flattish to 2018, and 2020, there's no doubt that there's going to take a hit because of what is happening in for COVID. So there's less demand, people couldn't go out, there are like credit issues here and there. That's why the loan volume go down a little bit. And we see that in 2021, that goes a strong rebound, given there is a COVID rebound for sure. And then you got a very slight flattish, but since then, still a little bit of growth in 2002 and 2023. And then, as Joe mentioned before, there's a dip in 2024. And I'll go deeper into 2024 to show you, to explain why. If you look at the chart, the blue one, the bottommost, the darker blue one, 46% of the volume is driven from refinancing. Now, if you look at some other years, just take 2023 as an example, only 35% is refinancing. Now, why is this important? It is because refinancing basically is a rollover effect. You always have that with maturities, and you always have to roll over them, or you always have to refinance them, or most of the time you have to. So that basically gives you a floor of the loan volume. Now, the sharp contrast between 2024 and 2023, if you look at the gray bar, and there's others, if you look at the blue bar, that's M&A. If you compare the light blue middle one, the 5% there or thereabouts, comparing to 2022, that's a sharp drop. The total as a percentage dropped from, call it 10, 11% to 5%. For other, supposedly, for example, CapEx, dividend recap, other corporate purpose, which means that in 2024, there are a lot less demand from that perspective versus the other years. So that's why if you're seeing the more refinancing as a percentage of the total loan, the actual loan or new cash demand actually goes down.
So maybe I want to talk about the M&A, which is the light blue, right? If you look at 2020, 2021, 2022, basically post-COVID, right? What happened to the market? A lot of the valuation went down, right? So for corporates and sponsors with dry powder, they were looking to acquire and build their empire. So which is why you see the M&A volume, it's close to 10%. And then 23, 24 onwards, what happened? We had the rate hike. And I said before, rate hike would mean more expensive leverage finance, bonds. And on the equity side, is valuations harder for people to agree on as well. Because sellers still think my asset's worth this, and then bidders want to go buy low, sell high, right?
Sure.
So hopefully, with interest rate potentially coming down, we're hopeful that the leverage finance market and M&A will gradually rebound.
I see.
Yeah.
I see. So that is our concern right now is to expect U.S. Might consider to lower the interest rate. But once again, there's lots of knowns and unknowns in this.
That's why it's best time to do this course.
Thank you. Yeah, definitely.
Right.
I got another audience question, which is they would like to know more about the private credit, especially in Hong Kong. Is it quite, based on your experience, is it quite active or there's more potential?
So let's talk about how the evolution of private credit came, right? I think it all started around 1920. A lot of the PEs were growing to a certain scale. And, for private equity, normally they charge investors like 2% AUM fee, right? They realized that's better than the performance fee of 20%. So they decided to look at what other options or strategy I can build upon. So they started looking at infrastructure. So they look at infrastructure strategy. They look at private credit strategy. So now, if you look at the top 10 asset managers of the world, they have every strategy available, right? BlackRock, KKR, Apollo, etc. They have every strategy available. They also started buying insurance companies.
Yes.
So they have long-term pension money, which is cheaper. So there's a lot of dry powder in private credit, but my personal perspective is it's still very competitive. Not every single fund can find interesting opportunity to deploy. But for Hong Kong specifically, I think last 3 to 5 years, a lot of the financing has been in real estate. And what had happened is that the HKMA were trying to tighten the screw on the gearing ratio of property financing. A lot of the banks were more close to the ceiling of what they could provide in the sector limit. So at the end, a lot of these borrowers went to the private credit community for financing. So that there has been trades done, but a lot of them is actually related to real estate.
I see.
Yeah. And just to add, there has been private credit deals done in Greater China tied to more of an equity takeout. Because, I mean, today the ECN market is coming back much more strongly. But during COVID, there weren't a lot of trades done, right? So a lot of the private credit funds basically, provide financing. Is a bridge to equity takeout, right? So that's some transactions we understand. Yeah.
Thank you, Joe. What do you think, Brian?
No, specifically in Hong Kong, I think it's very similar to what Joe has mentioned. I mean, there are a lot of expansion. Obviously, there are a lot of focus in that. In terms of specific transactions being done, I think there are still more industry specific in terms of what private credit can do. If we look at the trend, or if we look at the experience in Australia, that is different. And we think, my personal viewpoint is that I think we're like 3 to 5 years behind, where Australia is in the private credit market, where Hong Kong or Asia as a whole could pick up. We're seeing the start, or we're seeing some headlines in terms of what private credit can do in Hong Kong, but the private credit experience in Australia is very developed. They actually be able to provide another pool of capital, to call it the sponsors, so that they can complement with the bank financing that traditional banks do in order to close a transaction, for an example. So it's more to come. It's more to come.
Thank you, Joe. Thank you, Brian. Okay, let us see the next one. The regional MA loans distribution. So this is the Asian Pacific loans market. As we can see that. Is there any particular points being the audience we would like to pay attention, Joe and Brian?
I think you obviously see a pickup in Japan, as discussed before. The changes being initiated in Japan. Australia, it's increased from 4.6 to 7.5 billion. I think to echo what Brian has said, why Australia? Because a lot of the global asset manager, they have an Asia Pacific strategy. And Australia is basically the closest comp to US and Europe.
Yes.
So if they can deploy, start with Australia. And the similarity is mainly from a legal jurisdiction perspective, right? If you lend to a company in Vietnam, Indonesia, it's not nowhere near a US company. But you lend to an Australian company, it's very close to a US company, right? So sponsors are very active in Australia. So what has evolved is there's a non-bank market in Australia as well, institution investor market. So that has helped with acquisitions in Australia. You see the pickup. Yeah.
Right. So based on your experience, how about like we call the deglobalization? Like we can see the what happened in the U.S. I think is it today they raised the 25% tariff on all the car import to U.S. Under this deglobalization uncertainties, what do you think? Is it a good sign or bad sign for the M&A activities? Maybe they will shift, reallocate the supply chain allocations or etc.
I think there's good and bad in there, and in most of the things. I think you're right. So deglobalization definitely creates opportunities for, let's say, for example, a divestment or a spin-off from corporates or companies where they have operations globally, and there may be chances for them to just sell their non-core assets or geographies that having some of the issues in terms of tariffs that drives the demand for the loan financing, because there's just more M&A. On the flip side, though, then as we always mention, we also have to consider the risk. So, for example, for a company right now, if they are actually selling or revenue have 25% coming from the US, do we have to start thinking about what tariffs do to them? Do they have the local ability to manufacture stuff that they can sell in the US, or how much or how good or bad they are in terms of pushing down or passing through the tariff cost into their customers? These are additional due diligence and additional things that we have to do, given this background, given this situation. So both good and bad.
I think it's several factors, right? In terms of deglobalization, you are seeing change in supply chain. So companies are investing in like Southeast Asia, South Asia. That provides a lot of financing opportunities for banks like us. And then the other side is people are really considering corporate carve-outs, spinning off, segments where they might be impacted by tariffs. So again, there will be sell side opportunity and also buy side opportunity for banks, right? And obviously financing. Yeah.
Well, so we still need to face lots of knowns and unknowns in this fluctuated market. Okay, let's see. We would like to know how about the interest rate. We have 3 rates here. So, Joe, is there any?
So I think the takeaway for this graph is obviously we had the rate hike, and then now it's coming down a little bit.
Yes.
But the key is that there has been a growth in the local currency loan market. So local currency meaning, say in China, CNH, CNY, in Indonesia is the rupiah, in India is the rupee, right? There's a growth in the local currency market. And a lot of the companies, when they look at USD, Hong Kong dollar, euro financing, they compare the interest rate difference, right? And now for a CFO, probably they would think about, should I do more in the local currency loan market, right? There's a lot of liquidity in local currency loan market because a lot of these banks have a lot of deposits anyway. So it's very competitive, right? So if I'm a CFO, why should I borrow in USD when the rates for term SOFR, for example, is like 4% plus, right? Whereas, if the CFO is a China-based business, they can raise a local financing at 3% plus minus in RMB terms, right? They don't need to think about the FX hedging. It's matched to the asset liability, right? They probably have CNY asset and revenue stream. For the liability side, is matched, right? So I think that's the takeaway. Hopefully, when the rates, especially US dollar, coming down, that should make the US dollar more appealing for people to consider. Yeah.
You mentioned about the importance of local currency. How about direction or the American dollar when they appreciate or depreciate? Will that also make consideration when they are making the leveraged finance? If US dollar we expect, because Donald Trump said that he would like the American dollar to depreciate. That's what he's saying. So will that affect the decision in terms of leverage financing?
I think it depends on whether or not the company actually thinks that the USD depreciates, right? So it's more than just one person saying or not. So I think it's a market. There's a market for it, and so there's going to be price for it. I personally, I don't think there's a lot of CFO in a company place their bets in terms of what they think a currency appreciates or depreciates, because that's basically a very tricky and dangerous game to play. Because where we talk about here is the interest rate. So we're talking about 2%, 3%, 4% of the loan. When we talk about the FX, we're talking about the whole principle of the loan.
Yes.
So 10% movement means that your debt suddenly increased by 10%. So if you're not matching that with your increase in revenue, assuming that you have the same revenue stream, it's quite a dangerous game to play.
Definitely.
I mean, if we're laying a US dollar loan, we will obviously think about what's the potential FX forecast. We will also sensitize the model, right?
Yeah.
We may encourage the borrower to do hedging, but doing hedging has costs, right? And you may need to share the security package with the hedge provider as well, right?
Yes.
So these are all considerations we need to think about.
Yes.
Yeah.
Thank you, Joe. Okay, development in the leveraged finance sector. I think there's a number of trends and themes. So maybe Joe, can you enlighten us about this key trends?
So I think we look at the whole Asia. Let's start with Hong Kong, China. For leverage finance, I think the opportunity is definitely there for privatizations, especially for listcos with shareholding, where it's mainly backed by the main family promoter. The reason why is that if they need to do financing to delist and buy out the free float, the consideration is much less, right? So privatization, there's obviously a lot of corporate carve-out. We get asked a lot by companies globally. I want to sell my Hong Kong, China business. How can I do it, right? So there's a lot of opportunity there. And then we slowly move into India. So India is basically one of the hot market in leverage finance. It all started a couple years ago. There was a wave of business process outsourcing companies. A lot of these have US revenue as well. So they provide services, outsource servicing business and for like US clients. So US dollar revenue stream. So a lot of the banks were very comfortable lending against it. It's very low cost, but then they have US dollar revenue, right? The margin is very good as well. So BPO, so we are seeing a lot of these BPO companies, they're trying to expand bigger and bigger now. So they're looking at like bolt-on acquisitions across the globe to grow their business, right? And then the other thing we're seeing is before lenders are more focused on India business with offshore revenue. Now they're also more comfortable with pure domestic business. So we're seeing leverage finance opportunity across, basically tied to the Indian growth story, right? From wealth management, healthcare, hospitals, education. So everything without the US dollar revenue side, right? So that's India, the involvement of, tying to the India growth. Southeast Asia, I think, probably less activity, but I think another theme would similarly be the privatization I mentioned before. And then Australia, there's a lot of financing done because there's a lot of churn of private equity sponsors selling and buying asset, right? So that's on the countryside.
Yeah. On sector side, basically, I think we touched upon that. Technology, definitely one of them. Business outsourcing, which Joe has mentioned as well, obviously. For real estate, I think we have to bifurcate. From the whole Asia perspective, I think Greater China still is struggling a little bit in terms of real estate. But in, I think, Singapore, Southeast Asia, Australia, I think they're still doing pretty well from a sector perspective. There are more and more focus, I would think, as well from a industrial or manufacturing perspective right now, given what we have just mentioned about deglobalization. So there are more and more needs in terms of whether or not they can build locally for manufacturing facilities to supply locally and the supply chain. And so to speak, that logistic companies, because they are very useful and helpful and important in a world of quote unquote deglobalization to be able to ship and transport things from one place to another. I think that basically where we are seeing from a sector's perspective.
Thank you, Brian. Joe, what I'm here is I can see more upside potential rather than downside risk. Correct me if I'm wrong.
Definitely.
In the leverage finance sector.
Definitely.
Thank you. And how about any trends in terms of loan structures or if people working in leverage finance, people like to know that.
So I think maybe we can talk about financiers as well. So there has been a growth in different financiers throughout the last 10 years, right? 10 years ago, I think the leverage finance market's purely bank-driven. Today, you have an evolution of non-banks covering private credit funds, family offices, pension funds, sovereign wealth funds, security houses, and the likes. So because we have a much wider investor base, the structures are also evolving a lot today. So for corporates and sponsors, they're very blessed with a buffet option, right? So they can go to the bank loan market, Asia term loan market, which is leverage maybe 4 to 5x. That takes all the security, all the guarantee, and then pricing maybe like 3 to 500, sub 500 margin, right? And then they can also go to the more different structures, like can they do like a term loan B, right? Which is no covenant, 6 to 7 year bullet, or very little amort financing, but that needs rating, right? And then on the other side, they can also do what we call unitranche, right? Unitranche is basically one facility agreement, but you have different tranches, different creditors all signing to one agreement. And that structure, a lot of the times you can get even higher leverage, like 5 to 6x, right? Pricing is going to be much more expensive. Would be base rate plus 500 to 600 basis point. So they're blessed with different structures to choose. I think the other thing we're seeing is banks and private credit investors are getting more comfortable with minority-based financing. So what I mean by minority-based financing is you have a sub 50% stake and you want to raise financing against it. So when it's sub 50%, obviously you don't really have full control. So when people look through that, it's they will look at like what's the dividend, what's the debt serviceability, how much is the stake worth, how much should I layer the loan to value. So things like that. So I think that's major evolution in the loan structures.
I see. I can say that the prospect is very positive in this case. Yeah. Thank you. Is there any supplement from?
No, I think Joe put it very
I think the other thing we can think about is tenor. So the loan product has historically been more of a 3 to 5 year product, especially for the bank market. But for term loan Bs, which is a no financial covenant product rated to the institutional investor side, I think this is more for Europe and US market, but we're slowly seeing in Asia as well. So for term loan B, it's really no covenants. And the unitranche is basically a one financial covenant, right? So in terms of tenor, unitranche and term loan B usually are longer than 5 years. And we're also seeing banks actively looking at this structure, unitranche and term loan B. So I think through time, I wouldn't be surprised we start to do more 7-year financing or more than 5-year financing.
Thank you, Joe. Thank you. Okay. And then right now, I think before we have a questions keeps on coming, but before we did that, once again, thank you, Brian and Joe, give us a very, very comprehensive overview about the leverage finance. How about if I'm a student, I'm working in the bank, but not in this sector? Can you share with us what kind of skill set or maybe knowledge, which is very, very important if I get the opportunity to enter in this leverage finance field? Maybe Joe first.
Okay. I think for students who want to move into leverage finance, I think they basically need to have very strong credit skills, credit fundamental skills, because we are always looking at downside, right? So that's one very important element required. Number two, leverage finance and the syndicate loan business is a people business. Because when we do syndicate loan, we start from the process. Origination, we try to negotiate with the client on the terms, right? And then we structure the loan, we talk to our internal credit, why the loan should be doable, right? And then once we package the loan, we also sell the loan to other investors, other financiers. This is the syndicate and distribution piece. Right. It's also a people business. And then you'll be working with legal counsel, drafting the term sheet into docs. You also need to work with the third-party appraisers, because we will be looking at like commercial DD, legal DD, tax DD, business DD, right? So you need to know and how to interact with people, right? And then lastly, if the loan doesn't do well, like post monitoring, post closing, how can we recover the loan, right? Do I find an independent financial advisor to help? Do I talk to liquidators, receivers to help, right? It's all people business, right? So think about building your network across different skill set, right? So know some lawyers, know some bankers, know some clients, know some third-party appraisers, right?
But of course, at the same time, I think you also need to have a foundation in terms of compliance and regulatory framework. All this, can I say that? Wait.
That's why they need to do the course. Right?
Yeah, and more so from a technical perspective, I think Joe put it well that you need to have credit skills. But to break that down a little bit, I think number one, you have to know more about financial statements because it all starts from there. All analysis starts from financial statements. It would be good if one can be able to have some Excel modeling skills. That is also important as well. It would be good for this business to be patient. I think it is very important. So we work in a bank, and obviously a bank has very different departments. So we see people, let's say in the trading platform, like they do a deal in 5 seconds. We do a deal in a couple of months. But then the difference is we know the company in and out. We know the story in and out. We know the industry knowledge by actually working with the company to get the approval to lend the money. So it's a very different journey. You have to be interested in different parts of the world, in different industries, and in order to be able to master this. So if you're a person who just want to pick up the phone, 5 seconds, put it down, done deal, not the place. But if you're like me or like Joe, who loves exploring different worlds, different parts of the world, how things done, why a company does things like that, that this is the place to go.
Thank you, Brian. And I'm delighted to hear you mentioned that people business and communication skills, negotiation skills, which is AI cannot do it. But at the same time, how about, is there any impact from the AI for leverage finance sector? Or at least we need to know how to use generative AI to assist. Can I say that assist your deal?
I think so. I think it's more important than how you use it. There are a lot of quote and unquote repeating work that the AI could help you with. Let's just say, for example, you can tell AI to give you the last 10 years financials of a listed company. They can do that. They can ask. You can even ask them to do an analysis to see what it comes up with the credit. But they don't chat to the CFO. They don't know what the CFO thinks.
Yes. They don't know the strategy of the CFO.
Yes.
Or the character of the company. Right.
Yeah.
So that
culture.
That's right.
Yeah.
That's important because when we look at credit, one is looking at the financial statement, right?
Yeah.
The other is understanding the character of the company, the capacity of their debt repayment. You know, the four or five C's, what we call it, right? That is also very important. Yeah.
Thank you for your sharing.
And I think the other point I want to share is the loan product or syndicate lending or leverage finance. It is a very resilient product, I would say. If we compare to say equity or debt, during COVID-19, I don't think there were a lot of ECM, DCM activity, but there was still loan activity, right? Reason behind is that banks and loan product is still a bread and butter product for borrowers, for companies, and they also engage, daily dialogue with companies, including like, do you have a trade finance need or cash management need, right? Whereas debt capital market or ECM is more transaction basis. And you don't need it like every day, every month, every year, right? So I think a career in loan product is very fruitful and long-lasting because of the resilience.
Thank you. And once again, thank you, Joe and Brian. May I take this opportunity to let you know that, having said that, Hong Kong Youth Space and Asian Pacific Loan Market Association co-organized the new program, which is what we call Certificate for Module, Leverage, Acquisition, and Syndicated Financing. The class will be open in the late May, which is these courses will help you to understand more about leverage finance and like the legal requirement, Excel modeling skills, negotiation skills, and all the details things, loan B, etc., which is mentioned in this course. If you find that, like Joe and Brian mentioned, that this field is the prospect is very positive. Even under the AI right now, this is a die-hard field, and I definitely think that there is lots of opportunity, especially in Greater China. So if you're interested in this, please using the QR code to know more about our programs. Okay, so I think time is almost close to 2 p.m. Once again, on behalf of the school, thank you, Joe and Brian, to share your views. And I got a lot from this conversation. Once again, thank you very much. And we hope that maybe in the future we can see you in our classroom to share your maybe case or other experience with our students. Once again, thank you very much.
Thank you.
Thank you.
Thank you.
Thank you.
Bye.